How would you like to actually have some financial power? Well, it might just be coming, as President Trump signed an executive order to ban institutions from buying single family homes. With the lower demand, home prices are expected to fall significantly throughout the year, making it possible for you and I to actually afford one. How will this executive order work, and why are massive companies even able to dominate financial markets? Find out on this week's episode of Road to Riches. Welcome back to the episode, everyone. My name is Matthew White. Unfortunately, our co host Nyamki Buchanan could not attend today's episode due to technological difficulties. But we do have some very, very interesting things to talk about today. So, number one is Donald Trump signing an executive order today ordering and giving a referendum to Wall Street investors on how they can invest in the real estate market. So, coming out from Reuters on January 20th, U.S. President Donald Trump signed an executive order on Tuesday aiming to stop Wall Street investors from competing with individual homebuyers. So, what this order does is two things. So, number one, will give uh, this order will give the Treasury the ability to investigate uh, and enforce regulations on Wall Street investors to keep them from purchasing homes on the open market. Number two, it gives the Trump administration a 60-day referendum. And it says it's essentially the president saying, okay, so we have 60 days to investigate the problem ourselves. And from that investigation, we will enforce or write new regulations to keep Wall Street investors off of the one to four family housing market. Now, with this being introduced, I would like to add some facts to kind of give this some some context, because we've heard from the media, we've heard from popular culture that it's not regular citizens like you, me, uh, and your next door neighbor that are the problem in the housing market. We're not the demand that's keeping it so high. The rise in demand is actually due to Wall Street investors. And, uh, we need to bring some facts to that because it's not necessarily true. In fact, the opposite is true. According to the Brookings Institute, which is a think tank in Washington, most real estate investor sales are actually from mom and pop landlords. So these are the landlords that have, you know, two, three, four rental properties. Uh, I believe the stat is up to six rental properties are owned, up to six rental properties. Those people uh, own about 87% of all of the investor owned homes, which is combining Wall Street. It's combining Wall Street and it's combining the mom and pop investors as well. And so, and then when you account for, okay, well, what about 15 properties, 20 properties? Institutional investors who are defined by the Brookings Institute and by, for example, other companies like Batch Data, a real estate data platform, institutional investors are defined as holding 1,000 plus properties and or trading 1,000 plus properties in aggregate. And those investors actually only own about 2% of the overall housing market, and they don't account for a lot of sales either. Uh, and on top of that, about 30 to 35%, some estimates say even 40% of those investor owned homes find their way back onto the open market. And so a lot of these homes are being purchased, and they're not necessarily being rented out, they're being flipped. These investors go in and they purchase these homes, the run down, ragged homes, and they sell them for a profit. And so I think it's important to explain the other side of that story to say, okay, institutional investors aren't necessarily the problem. And what I think the president and what I think the Trump administration is going to figure out, if they haven't already figured it out, and what I think the general populace is going to figure out, is that it's actually the fault of the smaller landlords, the smaller investors. Uh, and to a certain extent, you can't really blame them. You know, you have things like Verbo, you have things like Airbnb, and these programs, these services, are so incredibly profitable. I mean, you think about Airbnb, for example. Being from a college town myself, you know, people will purchase homes, and people will purchase homes just to put on Airbnb because they know that there are, uh, for example, college fans all across the country, all across the state, who just want to come up for a weekend, maybe, and just relax. They don't want to come up on the day of the game because of traffic or what have you. And this can actually be very, very profitable for the actual property owner, because these people pay thousands of dollars just to lease this property for one weekend, just to rent it out for a weekend, maybe rent it out for a week. And so it's things like that that I think that people are going to start figuring out that's actually the problem. Maybe we need to regulate the Airbnb and Verbo industry. Maybe we need to start going after that, maybe tax it, maybe regulate it. As far as the order itself, I think the president's heart is in the right place once again. But again, uh, number one, you're telling very large investors what they can and can't do with their money. Uh, and number two, you're if looking at the data. If we actually investigate the data, you're not actually solving the problem. And it's inevitable that we find that the demand for said, uh, it's inevitable that we find that the demand for said products, in this case real estate, is not going to change much because those Wall Street investors, once again, according to the data, only made up about 2% of overall home ownerships. And even then, uh, they actually end up renovating and selling to the general market. But that's not to say that these Wall Street investors don't control certain markets. Uh, if we if we follow the rabbit hole a little bit, large institutional investors co- control the equity markets. And this is another data point that I want to bring up in regards to institutional investors. So, even according to sites like Yahoo Finance, that where they'll write articles about who controls the market, they estimate that the market is 80/20, in terms of Wall Street investors versus retail investors, which are people like me and people like you. And uh, and so this comes to a point where, you know, I think, for example, I used to think a long time ago that people like me were the ones who made the difference in the stock market. But that's not necessarily true. And if we look at the data, who's actually buying the stocks, who's actually selling the stocks, it's actually the Wall Street investors, simply because they have more resources, they have more information, and they can get information faster, especially with technology like HFT or high frequency trading. They can even trade faster. Um, but another thing is that we we think of this. There's this myth that we, for lack of a better term, uh, ground people will think about the Wall Street investors. These big guys. They're full of PhDs. They got their MBAs. They got their bachelors. Uh, and we're just, normal people. Maybe we got some PhDs and masters too, but on the aggregate, we don't hold the same kind of paper that they do. And we refer to this myth as the smart money myth, this idea that Wall Street has a crystal ball, that Wall Street can just, they're financial geniuses and they just got it all figured out. And that's not necessarily true either. So we think that Wall Street just beats us out because they've got credentials, they've got knowledge, they've got speed, and that's not necessarily the case. They're not necessarily smarter than us. They're just faster and they make more waves than we do. So an example is a getting their hands on, for example, a company's K10, which for those of you who don't know, a K10 is an SEC required, uh, essentially financial booklet. We'll call it a business financial statement for the time being, even though it's way more than that. So we'll just say it has the business's financial statements for the year. Um, and they're required by the SEC to file this at least once a year. And so, somebody gets let's say BlackRock gets their hands on Walmart's K10 uh, and early, and to avoid insider trading, what they do is they wait until the K10 is released, and that day when it's no longer illegal to act on said information, they trade. And of course they're so big that they make waves. And while you read the K10 a couple hours later and you made a trade based off of that K10, that the stock price is already being affected by the large whale that just traded. And so I mention all of this to say that Wall Street's capabilities are just far better than ours. When they splash, think of them as a whale. When they splash, they make a huge, they make a much larger wave than us, retail investors make. They simply have more information than we do, and they simply gain information faster, and they can act on it quicker. Uh, and so, you know, I think of it like an ocean. Once again, these investors are the whales, and we are plankton, or we are fish. Uh, and once again, uh, you know, in a world where it is just 80-20, they own 80% of the market. You, we don't have much of a say. And when we think we do, we actually don't. And they actually already know, with the exception of a couple times. There was one time in the meme stock era where everybody decided to purchase GameStop, where Wall Street did not have proper control on that matter. But that is the exception. And as I like to say, exceptions make rules. And so we get into this we get into this point where we as retail investors try to chase the whale, right? Whatever the whale is doing, the whale being BlackRock or Vanguard, or any of these large wealth advisors or equity firms. Uh, we chase the whale as a strategy because we know that the whale is more knowledgeable than we are. So when we see a stock making big moves, that's usually because an institutional investor has invested. And so we make this point of chasing them, doing whatever they're doing, and it can be hard sometimes. But sometimes, a lot of the time, these things happen in the news. These things are reported on, and so just be wary and again chase the whale. The problem with chasing the whale, right, is the other side of that equation, which is um, which is you retail investors find themselves holding the bag on the way on the institutional investor's way out. So what this means is that the institutional investor goes in, buys a stock, and it goes up, and the retail investors, us, end up buying it too because we see big moves in the market. Well, uh, actually, we're the ones who are holding the institutional investors' bag on the way out of the door. And it was because we tried to follow whatever they do, but they know exactly what we're looking, they know exactly what we're doing. They know that we're just chasing after them. And and so, we see this with, SanDisk. We saw it with MicroStrategy. And so, be on the lookout for that, which is why, uh, as we've said before, and as I've said before, time in the market is better than timing the market. Uh, Having a large presence, a large diversified presence in the equity market, in the stock market, is much better than trying to time the market just right, trying to time these institutional investors just right. And so, just be careful, be on the lookout for things that could possibly go bad. Um, and also make sure again that your portfolio is diversified to save you from some of these risks. Once again, you don't want yourself to end up holding the bag, but you also don't want to miss out on the growth opportunities that could come from chasing the whale. You just don't want to get run over. And then so this brings us into a hypothesis called the efficient market hypothesis, which is the theory that assets uh, already price all available information. And so, this idea that a stock already, so for example, NVIDIA with the AI boom, it's the idea that NVIDIA's stock price already has incorporated in it a uh, an AI boom. It already has that incorporated into the stock. And so when you think you're buying off of the AI boom, you're not. What you're doing is you're purchasing a stock that already has that fact built into the price. And so if we look at some statistics, uh, if we look at some data, uh, SanDisk soared because of AI, but it actually soared because that AI information was already priced in. Those institutional investors, once again, going back to institutional investors, already purchased that stock. And so all you're doing is is holding the bag for them, and you're just reacting to news that everybody else has already reacted to. You could hold on to it and it could continue to go up, but just know that you're not beating the institutional investors. The market is not what you think it is. Um, Once again, we have to be thinking about, in this case, compounding interest. So a lot of people know it as the eighth wonder of the world, and uh, uh, in a lot of cases it is. Investing in the stock market, again, most most reputable sources will say that over time the stock market returns around a 10% gain over time, and it's a very good retirement vehicle, among other things. And so let your interest compound, let your stocks grow, and be patient. Really is the lesson behind that, is to be patient. Don't try to beat the market. Remember, there are winners and there are losers in this market, and you do not want to be a loser. And there's a very high chance that you will, if you try to chase whales, if you try to chase hype. There's a chance you could win, but the chances of you winning are far lower than the chances of you losing. And that's the worry, especially for young people who don't have a lot of money to invest. And um, and so take that advice, and run with it. Um, And so, we come to this idea of also event-based investing. Once again, I mentioned the AI boom earlier. Well, actually, that's an event. The AI boom wasn't just Nvidia. It was Google. It was OpenAI. It was all of these different companies who drove the AI craze. Of course, everybody remembers ChatGPT being the first website to get over 100 million users, and I think it was something like a couple months, and it was the next new craze. And so that's an event that you could go to your wealth advisor and say, hey, there's an AI craze going on. Can I throw some money into Nvidia? Could I throw some money into Google? Tech stocks have grown substantially. um, and so, of course, we talk about SanDisk a lot because of storage. They're a storage company. uh, SanDisk has actually soared 74.24% uh, already in 2026. And that's massive for the company. And that's massive for the point that I'm trying to make, is that investing off of events is not exactly a bad strategy. Being in tune with the news is actually a competitive advantage that you as an investor can take to the market. And so we move on to this idea of elevated risk, to say that there is still risk in chasing a trend. There are companies who have done very well during certain booms. There's also busts, though, and there's companies who have done very poorly during booms as well, and vice versa. One such company uh, One such company would have been MicroStrategy, who through 2025 went down 52.67% over the year. And so this technology company, did very well during the height of the AI boom, but its stock plummeted 50%. Um, and it was just one of those things where there was a massive sell-off at its peak, which is another thing that investors need to be aware of. Nobody can pick it perfectly, and if you can, then maybe Wall Street has some jobs for you. But for us mere mortals, nobody picks peaks and valleys. And what happened with MicroStrategy, where it peaked and people thought it peaked and they sold off, that can happen during any trend, a bubble, if you will. And so, once again, we hear about the winners because it's more romantic. It's more uh, appealing to viewers. We do not hear about the losers, and trust me, there's a lot more losers than there are winners, in terms of people getting rich quick, or in terms of people picking the right stock and making massive short-term gains, or even medium-term gains. uh, Once again, you have a better chance of being successful in the stock market if you invest long term than if you invest short term or medium term, simply because of the risks associated with uh, chasing trends, getting ran over by whales, uh, or simply holding bags for the larger investors. And so I wanted to close this episode by saying, we're looking at the headlines coming out of Washington. We're looking at the volatility in stocks. We're talking about efficient market hypotheses, and we're talking about going after Wall Street investors for what we see as an injustice. Um, and so I want to just close by saying that the strategy isn't actually getting rich quick in the stock market. There's massive risks to it. I want There's massive risks to trying to get rich quick. There's massive risks in trying to find a shortcut. Um, I would say that the goal is to uh, uh, stay in the market and to invest your money properly and to just let compounding interest do its job. And so, you know, but also don't let the smart money myth trick you into thinking that, Wall Street is just always going to beat you. Maybe there's something that Wall Street missed, or maybe there's something that Wall Street is doing that you can also profit off of. And so, that's a whole different discussion entirely. But what I really want to drive home is this idea of compound interest and this idea of staying in the market and being patient. And and to piggyback off of my co-host's point in earlier episodes, remember that it can be done, right? This idea that you have to persevere. If you persevere, if you just stick it out, you will be surprised at what you can do. You will be surprised at what your money can do. And so just stick it out, stay faithful, stay focused on the future, and one day it will work out. Mathematically, it it is shown to work out for millions of Americans, and uh, and this fact hasn't changed. And so, again, the real financial power comes from compounding interest and staying in the market, not necessarily the getting rich quick, and trying to time the market, trying to follow off of trends. And so that's all we have for today. Thank you so much for tuning into this week's episode of Road to Riches. I'm Matt White. My co-host is Nyaki Buchanan, who once again could not be here due to technical difficulties. Make sure to like this episode. Make sure to subscribe. Leave a comment so that way, maybe we can figure out what else we can cover. Maybe get some feedback from one of you guys, and we will be featuring some comments on future episodes so that way we can respond to our fans. We can maybe shed some light on some things. Uh, and and just be watching out for some YouTube shorts. Watch out for some exclusive videos from us. But once again, my name is Matt White. My co-host is Nyampi Buchanan, and this was Road to Riches.